We'll move on to financial statement and ratios, chapter 15. The contents include 15.1, the income statement, 15.2, analyzing the income statement, 15.3, the balance sheet, and 15.4, analyzing the balance sheet. Okay, so 15.1, the income statement. Most important thing about what we're going to be learning in chapter 15 is terminology. If you don't quite understand the terms, then it's going to be difficult for you to get through everything. So my suggestion is you study, at least initially, you'll study the terms. See, the first thing we're going to learn about is the income statement. And what we're talking about are what we refer to as financial statements that really express the financial condition of a company. So people who are interested in how well the company's doing in terms of their finances will look at various financial statements, including the income statement. The income statement summarizes the firm's income and expenses for a specific period of time, such as a quarter or a year. Okay, so we start with gross sales or total revenues. That is the total amount of money received from customers. You then will take your gross sales and then adjust it based upon returns, which are returns from customers. And then what you have is net sales, which is really taking the gross sales and then subtracting the returns, and that'll give you your net sales. So net sales is equal to gross sales minus returns. After you get through the sales amount, the net sales, then you're then going to take into consideration the cost of goods sold. And the cost of goods sold is the amount paid by the firm for items sold to customers. So as an example, Walmart, let's say they sell you some disinfecting wipes. Get that? Like these. All right, so if you buy them, I don't know what they cost, but let's assume that this costs maybe $5. Well, Walmart had to buy them from the distributors, and so whatever they pay to the distributors, that's the cost of goods sold. So let's say they paid $3. When we go buy them, we buy them for $5. Our cost is $5, but Walmart's cost is only $3. The $3 represents the cost of goods sold. After the cost of goods sold, you have gross profit. Gross profit is computed by taking net sales minus your cost of goods sold. Next, we have operating expenses or overhead. A company has costs that are necessary in order to run the business. So Walmart will have expenses such as rent, advertising expense, utilities, property taxes. So all of these are going to be considered operating expenses. They're not part of the original cost of the goods because that's separately. We've already accounted for that. But they're identifying all of the expenses that are necessary to operate the company. And then from there, we can then compute net income specifically before taxes. So that's going to be the gross profit minus operating expenses. And then finally, we're going to take our net income. Net income is computed by taking net income before taxes, which is what we computed here, and then we're going to subtract income taxes. So if we just take a look at examples here, let's say we have gross sales of $100,000, and let's say we had $1,000 that was returned. So just as the formula suggests, we're going to take our gross sales and we're going to subtract returns, and that's going to give us net sales. Now, once we have net sales, we then can plug in what is our cost of goods sold. For a retailer or merchandiser, that's going to be the cost of the product that you're actually selling. And so let's say, for example, the cost of goods sold, and I'm just plugging in numbers here. Let's say it's $44,000. So our gross profit is going to be computed by taking net sales and subtracting the cost of goods sold. So that gives us the gross profit. And then from here, we then add in all the operating expenses. There's going to be a lot of detail to the operating expenses. But right now, we're just going to summarize it. Let's say our operating expenses were $45,000. And then we're going to take our gross profit, we're going to subtract our operating expenses, and that's going to give us operating income or income before taxes. We'll go ahead and factor in taxes. Let's say it's $3,000. And then from there, we can compute net income by taking income before taxes. We subtract our taxes, and we end up with $7,000. So here's a good example of what it would look like. Very simple because there's nothing to distract you. We're just going specifically for the terms that we just learned. But if you look on an income statement, you'll be able to find these categories and understanding what they mean, and then understanding how the computations work. Let's look at example number 1. A portion of Apple Inc.'s recent financial statement is shown. All numbers are in millions. So total revenue is 215, that would be billion, 91 million, which is actually, just as it's written there, 215 billion, 91 million dollars. And that's written there. So Apple is a global company with worldwide sales of electronic devices and music services and apps. About 60% of its total revenue comes from countries outside North and South America. So on page 612, you could see, very similar to what I drew up for you, you'll see the title of the income statement, the company, the title, the period of which applies. And then gross sales minus returns, in this case, are showing 0, which means net sales and gross sales are the same. The cost of goods sold is listed there, the gross profit, and that shows you the signs. So this is a pretty good illustration. Apple does not report returns on its financial statement, so they are shown as 0. It paid $15,685,000,000 in income taxes. There you go. Get it right here. We have it right here. $15,685,000,000. It's a lot of money. Leaving an after-tax profit of $45,687,000,000. The sum of the cost of goods sold, operating expenses, income taxes, and net income equal net sales. Recognizing that we're taking net sales and then we're subtracting expenses, including the cost of goods sold, operating expenses, and income taxes to give us net income. We know that we can take net income, we can add to everything that we'd previously deducted, including income taxes, operating expenses, cost of goods sold, and once we've done that, we're going to end up right back where net sales is. So as an example here, cost of goods sold of $121,576,000,000 plus $32,143,000,000 of operating expenses plus the $15,685,000,000 in income taxes plus $45,687,000,000 in net income. If we add those all together, we'll end up with net sales. Now, a sub-formula for us to come up with the cost of goods sold. If you recall, let's scroll up. The cost of goods sold is listed here. In this example here, it's $121,576,000,000. Well, there is another formula that we use that we can often use to really compute what is the cost of goods sold. And the way we sometimes compute it is we take the value of initial inventory, or what we started off with. We're going to add to that any cost of the goods that we've purchased during this period of time. We're going to add to that freight costs as well. So that's going to be added to inventory. And then we're going to subtract from that any value of ending inventory. If you think about it, if you started off with so much inventory in your warehouse, you could then go buy some and you pay for the freight. So you've got what you started with, you've added what you've purchased, and now you're like, okay, well, what's my cost of goods sold? Well, you haven't sold all of what's in your warehouse. Hopefully, you still may have some ending inventory. Well, if we use some backwards reasoning, we could take let's say the period started on January 1st, and now we're looking at January 31st. And we're trying to figure out what was my cost of goods sold during the period of January, from January 1 to January 31st. Well, if we started off with inventory, we purchased during that month so much, that's the cost of goods purchased. We had freight costs, and then we figured at the end of the period, at the end of the January 31st, we're going to go take a physical inventory. Well, that's what's still in the warehouse. So we take everything we started off with plus what we purchased, and then we subtract what's just left. Well, that must be equal to the cost of goods sold. Pretty straightforward formula. Initial inventory plus cost of goods purchased plus freight minus the value of ending inventory gives us the cost of goods sold. So let's take a look at this example. In the first year business, Decorative Stones Incorporated had $452,700 in gross sales, with returns of $38,100, inventory at the beginning of the year of $48,800, with the cost of goods purchased of $253,700 and freight of $7,430. Inventory at the end of the year was $89,090. And then expenses were as follows, are listed there. Complete an income statement using the following steps. Let's move on to the next page. So step 1 through 8, the first one is enter gross sales and returns and subtract returns from gross sales to find the net. We'll go ahead and use the layout I had before. So the first thing, step 1, we're going to find what net sales is, which means we're going to take gross sales and subtract returns. So gross sales of $452,700, $452,700, and returns of $38,100. So our net sales is going to be $414,600. Then we need to compute cost of goods sold. So we'll use the little formula we had learned just a bit ago. The value of the initial inventory, let's see, do we have that? The beginning of the year, the inventory at the beginning of the year was $48,800. We're going to look at the cost of the goods purchased, which the cost of the goods purchased is $253,700. We're going to add any freight costs. In this case, freight, $74.30. And then we're going to subtract the inventory value at the end of the year. Inventory at the end of the year was $89,090. So given this formula here, we should be able to compute cost of goods sold. According to my computation, if I take this, add, and subtract, I'll end up with $220,840. That's the cost of goods sold. We'll take that, and now we have the cost of goods sold here. $220,840. $220,840. Next, we're going to go ahead and subtract our operating expenses. Let's just run a list here. So operating expenses. Salaries are $104,300. Rent, $38,800. Advertising, $24,300. Utilities, $11,600. Payroll, $9,400. And miscellaneous, $13,350. So we can sum up all of these operating expenses. We get $201,750. So we can move on up to the income statement. And now that we have the sum of the total, we'll take that, operating expenses, and we end up with a loss of $7,990. Let's see how good we are. $7,990. Next page shows you the detail of what I put together in a little bit different format. Within the income statement, they actually showed the computation of the cost of goods sold, but ultimately those numbers are the same numbers that I used to come up with the cost of goods sold of $220,840. Gross profit of $193,760. Let's confirm. Yep, that's what I came up with. Total expenses, operating expenses were $201,750. That's what we came up with earlier. And then net income before taxes, $7,990. Since they didn't make any money, they're not going to pay any income taxes. So their net income is going to be $7,990.